capital gains tax, CGT, CGT, CGT. So for CGT, you say CGT is a tax that is levied on a transfer of property. Is a tax that is levied on a transfer of property structured in Kenya, acquired on or before 1st January 2015. So it is a tax levied on transfer of property structured in Kenya, acquired on or before 1st January 2015. So we got the tax rate. The tax rate is 15% of the net gain. So the tax rate is the 15% of the net gain. 15% of the net gain. In bracket, effective 1st January 2023 to date. Effective 1st January 2023 to date. Previously, it was 5%. So you need this one again. You need to be knowing the comparison, but that one will apply for the practical side. Because maybe you get a client who is complaining about the tax, but it is not relating to the current period. It is for the previous period. Then you'll have to apply the tax rate which was prevailing then. But if you find someone selling land today, then the current rate will be 15%. Now, the final tax. So it is the final tax, which means paid by the seller or a transferor and not subject to the further taxation. So once it has been paid, then that is the end of it. That is the end of it. Don't need to tax anymore. Don't need to tax anymore. So assets. So this asset applies to transfer, including the sales, gift, extinction, and the forfeiture. Forfeiture. So it includes sales, gift, extinction, and the forfeiture. So who knows who is doing the company law? The forfeiture is when you sell shares or the cancellation of shares. So then if you get those shares, then it will be subject, because we've been told forfeiture of. So these assets, these sales, gift, extension, and forfeiture of land, building, and listed shares. That's why we have a forfeiture, which it will relate to the shares. So unlisted shares, including 20% interest in a year, and other property in Kenya, and other property in Kenya. So these are the theory which you need to know about the capital gain tax. The capital gain tax. Now, how do we get this net gain? How do we get this net gain so that we take 50% of it? How do we get this net gain? So for us to get the net gain, you take the transfer value. Take the transfer value. You less adjusted cost. You less adjusted cost, then you get the net cash or gain. So that one now is subject to 15%. 15% is subject to 15%. Now, this is how we get now the transfer value. So just write the transfer value, underline, and say it is determined as follows. 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 Number one is the sales proceeds. So you take the sales proceed. You take the sales proceed less incidental cost. You less the incidental cost. You less the incidental cost. We have been given a note there. Say incidental cost on transfer of property includes. Incidental cost on transfer of property includes advertising, comma, conveyance fee, comma, legal fees, stamp duty, etc. Stamp duty, etc. And then how do we get adjusted cost? How do we get the adjusted cost? How do we get the adjusted cost? You say, this is determined as follows. This is determined as follows. We get the cost of acquisition. Cost of acquisition. You add the incidental cost. The cost of acquisition, you add the incidental cost. The incidental cost will be the same. So it is the same, the incidental cost. So I hope kila mtu umeandika, and make sure you're writing the note. So if you take the screenshot and you not have time to take this note, then you will forget. So make sure you are writing. The more you write, the more you will remember, and also the more you understand that concept. Instead of taking the screenshot, you go and forget to still write your notes or revisit it. So make sure that this we have 2 hours for class, so it is enough for you to make notes as we do the illustration, because it is better you reserve that time you could have taken to write the notes, you do the revision. Now, we have an illustration. We have an illustration there for capital gain tax. You write an illustration. So we have been told for the illustration, Mawela Property Developers Limited, Mawela Properties Developers Limited, comma, purchased a residential house on 1st January 2015. Purchase a residential house of on 1st January 2015 through 12% per annum mortgage of 4 million. The company incurred the following expenses in obtaining the loan. The company incurred the following expenses in obtaining the loan. Number 1, audit fee of 48,400. Number 2, valuation of the house. Valuation of the house for shilling 120,000. 120,000. We got the legal fees. The legal fees for conveyance, 80,000. The legal fee for conveyance, 80,000. Additional information. Additional information. Number 1, the company replaced all doors. The company replaced all doors. The company replaced all doors in the residential houses or house with metallic doors at a cost of 96,000. At a cost of 96,000. At the cost of 96,000. Number 2, on 1st December 2016, comma, the company sold the house at a price of 8 million. The company sold a house at a price of 8 million after incurring the following expenses. After incurring the following expenses. After incurring the following expenses. Number 1 of the expenses, repair of the house, 78,000. The repair of the house, 78,000. Number 2, advertisement of 24,200. 24,200. Agents commissioned of 12,000. valuation fee of 148,000, legal fee of 42,800. Required. Compute the capital gain or loss arising from the sales of the above house. Compute the capital gain or loss arising from the sales of the above house. So given the format, the two format we have wrote for the adjusted cost and adjusted or the net, the transfer value. So we'll have to do the two and then we get the different for us to get the net gain. From there, we subject to 15%.